Gold has popped $60 in the last two trading sessions and is now testing all-time highs at $20.93 per ounce as of the market close in New York on March 1st, 2024. This is a big shift from where we thought the market might be just a couple of weeks ago. We've seen a big sentiment change in the US economy and the inflation statistics, which mean the Fed may actually go back to pivoting. So what's happened in the last couple of weeks that have made such a big difference and have caused gold to catch a strong bid in just the last couple of trading sessions? Well, in this gold market commentary for March 1st, 2024, we'll get into it. Let me share my screen. So in this gold market update, gold tests record high. Inflation is easing, but it's staying sticky-ish, and it's a little confusing. And we're going to drill down on what's happening there. We'll also get under the hood on what's happened in the last 2 weeks, especially in the last couple of days, to change market sentiment back towards a Fed pivot. Also go over the latest charts, gold, silver, the US dollar, and Treasury yields. We've also got some great inventory specials that we've got available for our clients. So let's take a look at what's happening. Well, here's a one-year gold chart. And as you can see, all the way off to the right, highlighted in yellow, is that gold pop of $60 plus in just the last two trading sessions to push the New York close as of March 1st, 2024, back up to the previous all-time high of $2,093 an ounce. So what's happened to give gold a bid all of a sudden, and a strong one, with gains, future gains likely? Let's take a look. If you look at inflation, according to the Fed's preferred gauge, the Personal Consumption Expenditures Index, you can see in this gray bar chart that inflation is remaining sticky. It printed at 0.42% in January, which is equal to the highest print that we've seen since January of 2023. But the trend has been for lower over the last 12 months. So that's where the rub is. Month to month is one thing, but year on year is another. Now, we're going to get into the PCE charts for a yearly basis next, but I also want to point out here that spending, U.S. retail spending, is starting to fall, and you can see that all the way off to the right with the negative print for January. The negative print for January. The U.S. economy is 70% consumer driven. If the consumer starts to spend less, the economy will slow. And that's what higher interest rates are all about, slowing the economy. So maybe that lag effect is finally catching up to the economy. And maybe all that stimulus money that's been sloshing around for the last couple of years has finally been spent. In our last update, we talked about how credit card debt had reached record highs and savings has continued to fall to record lows. So the consumer in the US may actually be getting tapped out. Now let's look at the Fed's preferred measure of inflation, the PCE, on an annual basis. This is a PCE chart with headline in light blue and core in purple going back to 2000. You can see the big run up and then the big fall. Now this is last month's chart where headline PCE was at 2.6% and the core PCE was at 2.9%. When you go to this month's chart, which just came out 2 days ago, we've seen the headline drop another 0.2% down to 2.4%, and the core drop 0.1% to 2.8%. So inflation, as the Fed likes to measure it, is continuing to ease on an annual basis, but it has been a bit sticky on a month-to-month basis. And remember, just in the past couple of weeks, we got the CPI and the PPI, the Consumer Price Index, and the Producer Price Index coming in hot on a month-to-month basis as well. And that's where the stickiness is, but on the overall trend is for lower inflation, and that's good. What's changed in the last few days? Well, the PCE is at the lowest level in 3 years, since March of 2021, as you measure it from headline statistics. Consumer spending is slowing, especially for big ticket items like cars and consumer appliances. Why does this matter? Big ticket items are the first to fall off in sales when the economy starts to slow. Over the years, we've had a couple of car dealership owners as clients, and they've told us the same thing. We feel it first. So car dealers feel it first when the economy starts to slow. And when you see car sales start to fall, that's a big leading indicator. We're also seeing jobless claims are starting to creep higher. They were 215,000 last week, where at the beginning of the year, they've averaged 200,000 on a weekly basis, creeping up to 205 and then 210 and now 215. So there are jobless claims are creeping higher. And manufacturing, another leading indicator of economic activity, continues to stay soft with the ISM, the Institute for Supply Management, which measures manufacturing in the U.S., contracting in February for the 16th straight month. It's a bit choppy, but manufacturing remains weak. And all of this is pointing to suddenly a renewed anticipation of Fed rate cuts. Remember, Jerome Powell told us at the end of their mid-December meeting in 2023 that we should get 4 to 6 rate cuts this year in 2024. Then at the end of this January meeting, just a month ago, he said, hey, we might only get 3 cuts this year. Well, now the anticipation in the markets is starting to ramp back up as the economy shows some signs of weakness. And hey, the pivot may really be on, and probably for 2 or 3 rate cuts this year. And sentiment was a lot different just a few weeks ago, where some market participants were even suggesting we might get a rate hike in the coming months from the Fed. So let's look at how the market is anticipating the federal funds rate percentage to go this year. This is the Fed rate cut odds via the CME Fed Watch tool, which is a futures exchange where market participants actually put their money into where they think the Fed funds rate will be in the future. You know, as of the March 20th Fed meeting, 95% of the money is on the Fed funds rate remaining at 5.25%. Once we get to May, that shifts a little bit, with the odds of a 5.25% rate staying the same are 75%, while 23% of the money is saying, hey, we might get a 1/4 point rate cut by then. Once we get to the June meeting, it really starts to shift. So the market is really betting that the Fed will have one 25-point rate cut by the June 12th meeting. Once we get into July and September, the odds really start to shift towards not only a 1/4 point cut, but a 1/2 point cut or a 3/4 point cut from the current 5.25 rate in increments of a 1/4 point. Now, once we get to September, you've got to remember we're also into the presidential election cycle, and the Fed likes to be perceived as apolitical, although we think that they have become much more political over the last few years. So they really don't want to be doing anything drastic as of the September meeting. So we really have June and July as the active meetings where they might cut rates a 1/4 point, probably at each meeting. We'll see. And that's assuming that we get the soft landing that the Fed has been engineering towards for the last year or so. If things change dramatically, you know, these bets are off. But September is probably a hold meeting for the Fed because of the presidential election. And then the November 7th meeting is actually 2 days after the presidential election. So we'll see how things go. But this is how the market is betting the Fed will cut rates this year. So how does this translate into interest rates? Well, Treasury yields are what drive interest rates. And over the last 2 months, since the beginning of the year, we've seen the Treasury yields climb, but in the last week or so, we've seen them fall. And that's indicated by the yellow highlighted areas on both the 2-year Treasury yield in purple and the 10-year Treasury yield in red. So there's been a complete shift of sentiment in just the last week or so. And it's a big shift. Doesn't look like much on this chart, but the trend was for higher for the last 2 months, and now it's reversed itself. And this is what's helping to give gold a tailwind. And this is also starting to weaken the dollar as well. So here's the dollar chart going back to a year. You can see it's been pretty choppy, trading primarily since December between 102.5 and 104.5. We had that big dip at the very end of the year, but the trend has been for higher since the first of the year, peaking in mid-February at 104.85. but now the dollar's back to almost 104. So it's lost almost a whole point in the last month. And it looks like it can weaken further from here. This is, again, a sentiment change. So a weaker dollar and lower interest rates buoy gold. And in just the last 2 days, we've had the PCE print come out and also ISM manufacturing come out, which have been weaker than expected on an annual basis, which is helping to buoy gold. And here again, here's the gold chart. So you can see that bid that gold's caught in the last 2 days, but testing the previous high is a big deal. If we can break over that, we might see gold run another $50, $80 firmly into the 2100 range, up to maybe 2150. It did get to 2145 in intraday trading in the futures market in December. So that's really the previous top in the futures market. We'll see where this goes over the next couple of weeks. Now, this week, as you watch this video, we've got Jerome Powell testifying before Congress in his semi-annual testimony. We've also got a slew of Fed board governors giving speeches, and we have the ADP and the Bureau of Labor and Statistics jobs reports coming out. So this week, as you watch this video, will be a big week for market moving information. And the key to our economy are jobs. As long as we have a vibrant economy, we'll have employment. But if the economy really starts to weaken materially and we get some layoffs, that's what will drive the Fed to lower rates. And we're not there yet, but we may be inching closer to it as time passes. Let's look at what's happening with silver. While gold is testing new all-time highs, silver continues to lag, trading primarily between $22 an ounce and $23.50. Despite gold's pop in the last couple of trading sessions to testing an all-time high, silver still remains under short-term resistance, $23.50. It did gain about 50 cents today on the back of that $40 gold move that we saw today, which is Friday, March 1st. But it's still lagging. Now, silver is much more of a commodity metal than a monetary metal. So the weakness in the global economy is affecting silver demand, which is affecting the silver price. China's weak. Japan is basically in recession. Germany is teetering on the edge of recession. United Kingdom is in recession. The U.S. economy continues to be the only economy that's really performing right now, and that is affecting silver. And we're seeing that in the gold to silver ratio, which has popped back up to 90-1. Just a couple of weeks ago, it was 85-1 when gold was 20.15 and silver was 23.50. Now gold is 20.85 for round number sake, and silver's 23.15, and that puts the ratio at 90-1. So silver remains undervalued relative to gold. So that's the meat of our update. I do want to mention that we have some inventory specials that we can offer you, but you have to call us at 1-800-613-9323 to speak to one of our account managers to see what we have available. We have been buying a lot of precious metals, both bullion coins and numismatic coins, back from our clients and other sellers. And we're able to offer some better pricing than we normally would have, but inventory is coming and going fast. Right now, we're carrying a little bit more inventory than we'd like to, so we're making some deals. So if you're interested, please give us a call. Specifically, we have 1 ounce sovereign minted bullion gold and silver coins that are available. We also have some good deals on vintage European gold coins, and we have some US numismatic gold coins that we can offer some nice discounts on as well. It's a bit hit and miss, but maybe we've got something that fits what you're looking for. So that's our update for today. Thank you so much for your time. This is how you contact us. This is our 25th year in business. And as always, without our clients, we wouldn't have a business. So thank you so much for the support that you've given us for 25 years. And we'll help you in any way we can in the precious metals arena. Thank you.